Welcome to It's the Economy. Despite the fall we have seen in equity markets, the rupee today is higher, stronger, with reports that global treasuries are going short on the dollar and long on the rupee, that is, short on dollar rupee, hoping that a trade deal with the US is close. Separately, more brokerages like Goldman Sachs and HSBC have turned overweight on Indian equities, which is probably getting reflected in FPI inflows. Remember, they have been positive over the last 2 days. Finally, the GDP number that will come on November 28 for the July-September quarter is expected to be well over 7.5%, while the full-year GDP itself is getting revised by some economists to over 7%. To discuss the rupee and all things macro, I have with me Aurodeep Nandi, the India economist from Nomura. Good morning, Aurodeep. Thank you very much for joining us. I will have to start with the rupee because that seems to be the buzz now. There are people, yesterday the governor speaking at the V.K.R.V. Rao lecture said that, our current account deficit problems should be much lower once we have a good trade deal. What's the, sense at the Nomura desk? Are people turning short on dollar rupee?
Well, I think, look, there's a lot of uncertainty on the trade deal side. And, people keep thinking that, based on these rumors or these talks, a trade deal is going to come and then it gets delayed. I think the latest that seems to be coming from news reports is that the negotiations are over. There isn't anything fresh to discuss at this point. The ball is in the U.S. court. President Trump had said some time back that they are looking to come up with a deal soon. So again, I think, there have been so many false starts on this that it's more of sort of cautious optimism than anything. Okay. The big question actually that matters, Latha, is what is the tariff rate that will come after that the deal is finalized, right? So if it comes down to, say, 15 or 20%, then that's a big thing for India, right? Because that puts us in par with the rest of Asia.
Yes.
And so the competitive disadvantage that we have currently will get resolved.
Yes.
On the other hand, if it's still higher, so exporters would still need to, give some amount of discount to make themselves competitive. So I think there's just a lot of uncertainty still there. And,
now, what kind of a range are you all drawing up for the currency, therefore? If there is a trade deal, does it go to 87 or even more? If it gets postponed, say, beyond December 31, the market may worry. So then what happens? Is there any range you are working with?
I mean, our house view is that a deal will eventually happen. Our sort of numbers which we are looking at is the end of the year, we are looking at around 88. And then we expect, we have a slightly strengthening bias. So Q1 2026 at around 87.6, and then end of 2026 at 86.5.
Oh, 86.5. That's strong.
That's the end of.
Yeah, I get it. 12 months from now or something, or maybe even more. I take your point of that. But okay, let me come back to the macros then. The October deficit numbers were a little difficult to swallow. Has that increased your current account deficit forecast? And if yes, then it doesn't square with your strengthening rupee bias.
I mean, of course, it was a surprise, right? So a country that runs around, $20-25 billion, at max $30 billion, recording a 41 point something billion dollars of trade deficit is pretty elevated. And I think a couple of things are happening, right? Because on the one side, exports are getting hit because the tariff impact is coming through. On the other side, the import side is kind of sticky. There is gold imports that has been pretty high, and even broader import basket seems to be holding up. So you have the export minus import trade deficit elevated. Now, to your question of whether we've increased our current account deficit number, we have. So, but not by much. We had 1.1% of GDP. We raised that by 0.1% of GDP. So FY26, we have 1.2% of GDP. So certainly not something that sort of evolves into a big external risk going forward. Also remember that the last quarter of the fiscal year typically sees seasonally that the trade deficit improves.
Yes.
So you also need to factor that into account.
No, fair point. We have reported trade surpluses in past quarters in Jan, Feb, March. And of course, now we hear of some brokerages turning positive on Indian equities as well. Okay, Aurodeep, let me come to the big number that will come on November 28. What's your own expectation of the quarter gone by in terms of GDP and the full year GDP numbers?
So we have 7.6% versus 7.8% previously. If I'm not mistaken, I think we are at the higher end of the market at this point. Just two health warnings, Latha. I think when someone interprets this data, one is that the 7.8% that was there in the first quarter of this fiscal year was distorted because of lower deflators, right?
Yes.
So real GDP is nominal divided by deflator, because prices are inflation is so low that it sort of brought up the GDP number. I mean, you may recollect that before that number, economists were saying 6.7%,
Yes.
right? And it came out 7.8%. So we are now going from that base. So the base is a bit elevated. The second aspect is that the deflator problem is likely to be even more this time, because both consumer and wholesale price inflation has gone further down. Right. So be prepared for these, trends, some trends in the data which won't be, which will be difficult to sort of explain.
Yeah, but y'all are expecting a stronger rupee by the end of over the next 12, 13 months. As well, I think I don't know whether I read it in the Nomura report or in other reports, there is a severe Asian disinflation likely to continue because of overcapacity in China, etc. So next year also could be a 7% GDP. How are you looking at FY27 growth for India?
So FY26, we have 7%. For FY27, we have around 6.6% or so. So, it should moderate from this year, but you're right, there are some positives which are there. One is the trade deal. The other one is, let's remember, there's been a huge amount of policy easing that's happened this year that reverses the policy easing which was happening the year before, right? So be it on rates, be it on fiscal policy, be it on macroprudential measures, and then that takes some lag to sort of course through the
reflect in the economy.
Reflect in the economy. And also our expectation is that the global economic scenario remains somewhat positive. So if US, EU sort of does okay, then plus a trade deal would mean that it should be better for India. So it's sort of a mix of these factors.
Okay, so Indian growth likely to be positive in FY27 as well is your base case, right? What's the expectation from the Reserve Bank? Therefore, the Reserve Bank does look at forward inflation and not just at the 0.25% that happened in October.
This is going to be a really tough call, right? So, okay, our baseline is that there's going to be 50 basis points more of cuts. So our terminal rate is 5%. Now, the question, Latha, in all of this is when, right? And December is going to be a really tough call, right? Because on the one side, the RBI has said that we have policy space to ease. And that has been interpreted by a lot in the market, saying that, okay, so when a central bank comes and says there's policy space to ease, that is a signal that easing is going to come. But on the flip side, there's also been communication on the fact that, look, is there need for easing? And generally that, because if you look at the data currently, it shows a mix. It's a very confusing period for India, because you've got the Trump tariff effect, you've got the GST cut effect. So all of this is sort of creating a way in which economists are finding it struggling to sort of figure out, well, what is the true state of the economy? And so for the RBI could also argue, well, growth is fine at this point. Let's look at the forecast which RBI has. RBI's forecast for GDP for this Q2 of the fiscal year is, if I'm not mistaken, 7%.
7%, yeah.
So, if we are right and it comes out 7.6%, so the GDP forecast is going to be
revised higher.
And their inflation forecast for FY26 is pretty high, 2.6%. Our number is 1.9%. So there's also going to be an undershoot on inflation. So a combination of an undershoot on inflation and overshoot on growth ideally should not mean that you should
have to cut rates.
Yeah. So it's sort of a weird kind of thing. And just one last point, which is that a lot of people say, okay, because inflation has been so low, the RBI should cut. In theory, yes. But then inflation was also low in the October policy meeting.
Yes.
So if that was the reasoning, then the cut should have
Yeah.
happened then. So
Yeah.
our baseline case is still a December cut, but
Yeah.
it's going to be a really close call.
Yeah, there is an old RBI feeling that India's real inflation is 4%. I mean, the flexible inflation targeting has brought it down, and therefore it's 4. Therefore, 5.5 is not a bad number itself. The 2 cuts, I don't think, is in their horoscope, is not in their DNA. But you never know. There is a new man at the top, and there is a new set of data coming in. Thank you very much, Aurodeep Nandi. I understand that we are in difficult times for the Reserve Bank, and we have to wait and see. But at the moment, the bond market itself is not very excited, even if there is a cut, because they look at it as possibly the last cut. Thank you very much. We will touch base yet again after the Reserve Bank announces its policy, and of course, after the big macro data comes on November 28. We wrap up on Bazaar on the note that the rupee is strong, irrespective of the fact that equities have not done too well. Let's see how things pan out from here on. After the break, it's time for Chartbusters.